Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
The Bank of England has cut its economic growth forecast for this year and next, as it says the economy will remain sluggish. It reduced the growth rate for 2017 from 1.9% to 1.7%, and for 2018 from 1.7% to 1.6%. It also decided to keep interest rates unchanged at 0.25% after slowing inflation. Governor Mark Carney says Brexit uncertainty has played into the slowdown in the economy.
Since the referendum was called, UK households, businesses and the financial markets have reacted at different speeds and to varying degrees to the prospects for the UK's departure from the EU. Financial markets, particularly sterling, marked down the UK's relative prospects quickly and sharply. Households looked through Brexit-related uncertainties initially, but more recently, as the consequences of sterling's fall have shown up in the shops and squeezed their real incomes, they've cut back on spending, slowing the economy. Businesses have been somewhere in between. But since the referendum, they've invested much less aggressively than usual in response to an otherwise very favorable environment.
Let's talk to our economics editor, Ed Conway. He's outside the Bank of England. And Ed, a bit of a surprise in that announcement this afternoon.
Yeah, I think, looking at the bank's economic forecasts, they've brought down the forecast for this year by a small amount. They brought down the forecast for next year by an even smaller amount. The interesting thing really, though, and perhaps we're in an era where people focus a bit less on forecasts and more on what's actually happening, is when they look at how the economy is faring right now, so how it's fared over the course of the last 6 months or so. They say we are now, and you kind of heard it there from Mark Carney, they say we are now actually starting to see the impact of the referendum now feeding through to the economy. So people cutting back on spending, people seeing a squeeze on their real incomes, businesses starting to cut back on investment as well. And the bank says that by 2020, business investment, so businesses spending money on the economy, on their companies, in order to try and boost growth, that is going to be lower by 20% by 2020 as a result of the referendum. So I think the distinction now is we're seeing the bank saying this is already happening. The economy is already being affected. It is already slightly weaker as a result of the referendum. And that's quite a shift from saying it's going to be weaker in the future. In terms of what the bank actually did, well, they cut their forecast slightly. They left interest rates on hold. That's not necessarily a surprise. But they did signal that rates may well have to rise a bit quicker than anyone expects in the coming years, which of course is going to be a concern for households, given that they are feeling that squeeze on their incomes. When the pound fell after the referendum result, that in turn fed into inflation, which has in turn made the cost of living a little bit higher and meant that that money that you get in your pay packet every month doesn't go as far. All of this is being hung over by concerns about how that transitional period is going to be negotiated. And that's something I asked the governor about just earlier on.
In terms of transition and other aspects related to the negotiations, because any transition or implementation arrangement is part of the negotiations which have really just started. I wouldn't handicap the probabilities. We're not directly involved in those negotiations. We'll see how they transpire. We do think it is important, however, to have a transition arrangement.
So that was the Governor, Mark Carney, just a moment earlier, and it really is that point that we heard from the Chancellor, didn't we, last week? We spoke to him and asked him whether weaker GDP, which we saw, so weaker economic growth across the economy, was due to Brexit, and he said it partly was. Now we're hearing a similar story from the Bank of England Governor, concerns that the Brexit effect is now taking hold.
OK, Ed, thanks a lot.
Brexit again.
Yeah, and it is that kind of refrain, and I'm afraid, Kay, it's likely to continue to be, the second word that we hear from economic analysts for quite some time, because according to the bank, it is the big issue that's hanging over the economy at the moment, given that many businesses are trying to decide, and indeed households are trying to decide what they do in the future, and they can't really know for sure how much to invest in their factories until they have seen what kind of a deal the UK is likely to get, and that's why the Bank of England made this signal today. The interesting thing really isn't just the economic growth forecast, because we're all a little bit sceptical about forecasts these days. It's that now the bank is saying that Brexit is actually affecting the UK economy. It's not just a prospective thing, it's actually happening now. And according to the governor, as a result of the referendum decision, the UK, in terms of its business investment, is going to have 20% lower business investment by 2020. And it's all because no one's entirely sure what's going to happen with, for instance, the eventual deal we get, let alone the transitional period. So whether there's going to be a cliff edge or whether the UK is going to have a smooth transition. And that's something I asked the governor about, and here's what he said earlier on.
In terms of transition and other aspects related to the negotiations, because any transition or implementation arrangement is part of the negotiations which have really just started. I wouldn't handicap the probabilities. We're not directly involved in those negotiations. We'll see how they transpire. We do think it is important, however, to have a transition arrangement.
I think that was the governor earlier, and I mean the other striking thing, Kay, interest rates still down at 0.25%. The bank agreed to leave them unchanged where they are at the moment. It's the lowest they've ever been. The expectation isn't that they're going to go up anytime soon, but the bank did say if the economy does strengthen, then rates could be heading up a bit higher than anyone expects. But for the time being, 0.25%, the lowest rate in history. It's unusual times, and they're likely to continue for a while.
OK for now, thanks.
If there's one place most of us have noticed the impact of Brexit, it's here in the kitchen. Since the referendum, food prices have climbed ever higher, just one of the side products of the falling pound. And for this catering company, that's something of a headache. Do you raise your prices in turn and alienate your customers, or do you swallow the cost? So far, they've gone for the second option. Even so, since everyone is more squeezed these days, business is still getting tougher.
We've definitely seen an impact from the slow growth for the UK. You know, we're a business that's based in London. We're heavily dependent on how consumers are spending at home, and deciding to spend on little luxuries like ordering a really nice takeaway on a Friday night or a Sunday night, and that has an impact on us.
But if you're running a business, the most important ingredient isn't just prices, it's being able to plan for the future. The more confident you are about where the economy's heading, the more you'll invest. According to the Bank of England governor, this is one area where businesses are already cutting back.
You said in your opening remarks, Governor, that Brexit is beginning to affect potential supply. I mean, translated, does that mean that the economy has now been damaged by the vote?
It's evident in our discussions across the country with businesses. It's evident in our decision-maker panel survey. It's evident in other business surveys. It's evident, I think, in the reporting of a number of people in this room, that uncertainties about the eventual relationship are weighing on the decisions of some businesses. We see it directly in the macroeconomic numbers. Investment has been weaker than we otherwise would have expected.
You see, economics isn't just about forecasting the future, it's also about diagnosing where we are at the moment. And the verdict we now have from the Bank of England is that the referendum is starting to weigh on confidence. It's starting to weigh on business investment. In short, the Brexit effect is now taking hold.
Then again, the UK is hardly in recession, as some economists forecast last year. Still, a weaker economy means less income for everyone.
What do we want? Fair pay! When do we want it? Now!
This week, for the first time in half a century, some of the bank's own staff are on strike. Austerity is still hitting home, even in Threadneedle Street. Ed Conway, Sky News.
The Bank of England has said families are facing the worst squeeze on their incomes for more than a century. It's warned of slowing economic growth and rising inflation. The bank's governor, Mark Carney, said that uncertainty over Brexit was curbing pay rises and leading to delays in business investment. Here's our business editor, Simon Jack.
There hasn't been much summer cheer on the beach in Margate this week. The weather overcast and some bracing headwinds, much like the UK economy. And there was precious little sunshine shed when the Bank of England governor delivered its latest forecast. He explained how the recent fall in the pound was starting to make us all poorer.
Households looked through Brexit-related uncertainties initially, but more recently, as the consequences of sterling's fall have shown up in the shops and squeezed their real incomes, they've cut back on spending, slowing the economy.
The bank cut its growth forecast for this year from 1.9 to 1.7%. It also downgraded its estimate for next year from 1.7 to 1.6. Meanwhile, it pushed up its inflation forecast, saying it'll rise from 2.6% now to peak around 3% later this year, while wage rises this year remain unchanged at 2%. That widening gap is being felt in Margate.
Price of food has definitely gone up. Butter, cheese, bacon, I've noticed those things have gone up. And yeah, I mean, wages aren't going up in line with inflation.
The bus, transport, everything is so expensive now. So I drive now, and even then, like, car insurance has gone up. That's just getting ridiculous now, £140 a month. You can't afford it, you know.
Prices are going up and our pensions aren't keeping up with it.
Well, for the same amount of money, you're getting about 2/3 of the goods that you used to be, so we're cutting back all the time. So in another year's time, I'll be sitting here, a little skeleton.
Brexit was the theme that ran through everything the governor said today. The post-referendum fall in sterling has pushed up prices. That in turn is affecting consumer confidence, and businesses faced with uncertainty are not making investments they otherwise would have made. And all of those pressures are combining to affect the UK economy's long-term ability to grow.
Business investment is still likely to grow below historic averages, with adverse consequences for productivity, capacity, and wages.
For many, however, the bank's pronouncements are not only too downbeat, but also stray too far into politics.
Well, we should take the Bank of England's forecast with a pinch of salt. They're notoriously bad at forecasting. And then, of course, we have Project Fear Mark 2, the Bank of England, the CBI and the Treasury Department are all ganging up again to make us frightened of Brexit.
Even the bank's own staff are unhappy about wages. It's only when pay starts to catch up with prices that we may see interest rates rise. That's not expected till next year. Simon Jack, BBC News.
So what's Scottish whisky got to do with Brexit? Well, for one thing, during the EU referendum, many of the country's producers were big supporters of the Remain campaign. But now it seems many have had a change of heart, buoyed up by the prospect of one-off trade deals with countries like India, where they currently face massive tariffs. Our Scotland editor Sarah Smith reports.
The barley, the water, the weather make Islay malts unique. And on this small island, whisky is very big business. Almost 90% of Scotland's amber liquor is exported overseas, so Brexit will certainly be felt here. Small distilleries like Kilhoman don't want to lose the protected status for Scotch whisky offered by EU law, and they worry about the bureaucracy that leaving the single market might entail.
Whereas it was very easy to export into Europe, it's now going to be a little bit more difficult. And certainly for smaller companies, I think that will have an impact because of the amount of people we have to comply with all the new regulations.
Many of the island's distilleries are owned by big firms that supported remaining inside the EU, but they're now eyeing up the opportunities Brexit could bring. The whisky industry is hoping to expand sales in countries outside the EU. Countries like India, for instance, which currently slaps a whopping great 150% tariff on Scotch. If a new bilateral trade deal could eliminate or slash those tariffs, sales would increase enormously. The UK government can't guarantee tariff-free trade, but say there is now the opportunity to try.
And as part of this new arrangement in a post-EU world where we're negotiating the terms, we're not bound in by EU terms, we're able to negotiate our own terms, getting the right deal for the whisky industry is one of our priorities.
So it's a Speyside.
Scotch whisky is a valuable product,
It's 25 years old.
contributing about £5 billion a year to the UK economy, supporting 30,000 jobs and making many drinkers happy. It's an industry that first feared Brexit and now hopes to make it work for them.
Very nice.
Once we leave the EU, we would be the UK negotiating free trade deals rather than a bloc, and so that simplifies the negotiations to a degree. And so yes, we hope that it will be easier for the UK to negotiate a free trade deal with, for example, India.
The economy of Ireland runs on whisky. Much of Scotland's economy relies on this water of life. And they're now looking beyond the shores of Europe to try and make the best of Brexit. Sarah Smith, BBC News, Islay.
Now, the prospects for the UK economy are bleak, as the Governor of the Bank of England warned it would stay sluggish. The bank's now lowered its growth forecast for this year and next and voted to keep interest rates on hold again. And Mark Carney warned that business investment was weaker than expected because of the uncertainty surrounding Brexit. Our economics correspondent Helia Ibrahimi has this.
Can we have the mocha, please, and the mint chocolate?
If Britain is a nation of shopkeepers, what the Bank of England served up today may leave a bitter taste. Consumers under pressure, prices climbing, and business investors nervous about Brexit.
You're looking at something like a 10 to 15% swing in margin just because of the pound devaluation, which is huge in any industry. There are probably three major factors: import prices, inflation, consumer appetite to just spend their money. All of those things stack up to be very high odds against any small company trying to survive.
Over at the Bank of England, Mark Carney warned that British households and companies were in the teeth of Brexit's inflation cycle.
As the consequences of sterling's fall have shown up in the shops and squeezed their real incomes, they've cut back on spending, slowing the economy. Indeed, in the MPC forecast, uncertainty about the eventual shape of the UK's economic relationship with the EU weighs on the decisions of businesses and households.
In today's inflation report, which is the Bank of England's quarterly health check on the UK economy, growth in the UK was downgraded, both this year and next. Pay growth was also forecast to fall from 3.5% to 3%, putting more pressure on household incomes. And finally, the forecast for the level of investment in 2020 was 20% lower compared to where it was before Brexit. The bank also stressed how important it was for the government to secure a transitional deal to stop businesses facing a trading cliff edge in 2019. But recent government splits have shown that there is confusion even in the type of transitional deal the Treasury and the rest of the Cabinet want. For Ed Foy, there is an increasing list of problems about how his business will be able to buy and sell from Europe.
What is hard to see the future with clarity, because we just don't know what decisions will be made and therefore what quite big impacts will happen. So it makes it harder to raise money. It makes it harder to have conversations with people about what the next 2 years will look like. Whereas before, we kind of could say with certainty, this is our growth, these are our margins, and let's keep going.
If the UK is to regain some of the growth it's lost, businesses will need some more clarity on how they will be able to trade with the rest of Europe.
Helia Ibrahimi reporting.
Well, who would have thought it? The Bank of England didn't raise interest rates again today. And it also published its latest quarterly inflation report, which gave a somewhat Brexit sceptic view of the economy. The bank's not predicting doom and gloom, but it is predicting economic mediocrity. The bank governor didn't use the words, despite Brexit, the economy is going quite well. He more or less said, because of Brexit, the economy is not doing so well. 3 reasons. In the short term, it's all about us, the consumer. We've already been hit by an effective pay cut, thanks to a lower exchange rate, pushing up prices.
Households looked through Brexit-related uncertainties initially, but more recently, as the consequences of sterling's fall have shown up in the shops and squeezed their real incomes, they've cut back on spending, slowing the economy.
Right, that's the first. In the medium term, it's about business investment, because if consumers spend less, we'd like companies to spend more.
But since the referendum, they've invested much less aggressively than usual in response to an otherwise very favourable environment.
And then there is the long term, because if you have less investment now, it doesn't just mean less spending by companies, it means less productive capacity into the future.
Moreover, prolonged low investment will restrain growth in the capital stock and increases in productivity. Indeed, if the MPC's current forecast comes to pass, the level of investment in 2020 is expected to be 20 percentage points below the level which the MPC had projected just before the referendum.
Governor Mark Carney. Well, look, that's the bank's expert view, but who knows if they're right or if they're trapped in a Remainer mindset and just sticking to an old script. With me now, Gerard Lyons, one of the most prominent Brexit-supporting economists who worked closely with Boris Johnson, and Anne Pettifer, who is author of the book The Production of Money and a member of Labour's Economic Advisory Committee. Gerard, do you agree with my interpretation that the bank is basically taking quite a Brexit sceptic view there?
Certainly, clearly one needs to be realistic about the near term because there are challenges. What struck me today was that in his opening statement, the governor was very cautious. He almost blamed Brexit for everything. And then in the 1-hour press conference, in terms of the short term, he came out with 4 positives. And in my view, if he was balanced, he should have mentioned them at the beginning. Inflation, he said, is about to peak. So by next year, it will be falling, boosting real incomes. Consumer spending is going to grow in line with income. Therefore, there's not going to be a rise in debt. He said the balance of the economy is going to improve. Exports and investment are picking up. Then also, he talked about the fact that the world economy is going to improve. So quite frankly, even though he was very cautious, in the 1-hour press conference, one had to almost squeeze out of him reasons to be optimistic. So clearly there are challenges. No one denies those.
Okay. Well,
is that the way you read
the problem with that is that the bank has been optimistic over a long time. It's been optimistic about wage rises, it's been optimistic about investment, it's been optimistic about all kinds of things and proved wrong. I mean,
but it was pessimistic about Brexit, wasn't it? I
mean, yes.
There was a lot more going to go wrong than did go wrong.
This time last year, Mr. Carney said, plan is better than no plan. And fully a year later, there is still no plan. So Mr. Carney has every reason to be concerned.
But if we go back to a year ago, the Bank of England, and in particular the Treasury, let's remember, said that by now, this August, we would have 500,000 people unemployed because of the Leave vote. What's happened? Unemployment is at a 42-year low. Now, there are challenges. Wages are not picking up. The governor today seemed to suggest that was because of Brexit. But in America, wages not rising. In Eurozone, they're not rising.
That is what's so scary. You know, the global economy, despite what Gerard says about the positive aspects, the global economy is weakening. Wages are weakening across the board. Inflation is falling. And everybody's been warning about rises in inflation. And we have members of the Bank of England, MPC, willing to put up interest rates at a time when the consumer is quite vulnerable and we're very dependent on the consumer and where there are very high levels of debt. Right. So you know, I don't think there is half as positive.
You're a little bit more.
Very skeptical.
I mean, is it your view, Gerard, that there is a kind of a groupthink or a confirmation bias or some kind of cognitive process that is gripping the economic establishment and the Bank of England in particular that governs this?
Economics has been gripped by groupthink for ages. I remember when I said the Lawson boom was going to become a bust, I was told I was wrong. I was told that if we left the ERM, it was good news. I was told I was wrong. Economists tend to, unfortunately, go into this groupthink. Today, though, what is interesting, over and above the groupthink, and it's something that Anne touched on, it really is about longer-term, deep-rooted structural problems. What was underlying the bank's pessimism was not Brexit, it was really a lack of investment and low productivity.
But then add Brexit to that, add a lack of planning, add a government that is paranoid and...
They certainly should plan more, there's no doubt about that.
Do you buy this figure? And in 2020, 20% lower investment than there would be if we hadn't gone...
I think that's very possible. And there is deep lack of confidence. You know, the big thing that's missing, Evan, is that the private sector is over-indebted, worried, lacking in confidence, frightened, terrified by Brexit, unlike Gerard. And the government at this point should be stepping in. And instead, the government has promised investment that Robert Choate says will not even move the needle, will make absolutely no difference.
So you'd like more infrastructure or something like that?
Well, the government has to step in because the private sector is so weak, despite low interest rates, despite everything.
But Gerard, do you buy the figure? Do you accept that in 2020 investment may be 20% lower than it would have been in the absence?
No. Yes, private investment, definitely.
Today, again, the governor said supply potential of the economy is down to 1.75%. That's trend growth. But then in the press conference, he said, we've been cutting it for the last 9 years.
Yes.
What we need is the 3 I's. I agree with Anne. Investment, infrastructure spending and more innovation. If we have Brexit and we do it properly, we will not only protect workers' rights, we will actually have more innovation from the small, medium-sized business sector, the growth engine of the economy.
This is far too delusional, honestly. I mean, you can't.
There
let
are
this
challenges,
pass.
I agree.
Brexit is going to be utterly disruptive, and we have no plan for it, no short-term, medium or long-term plan for what's going to happen to all this complex network of relationships, trading relationships that we have with our European partners. We have no plan. We have no proper transitional plan.
Right.
You know, so
well, let's put that
and that is terrifying, and that is why we have low levels of investment, low levels of confidence,
we've had low investment
and why
for
we will
20
continue
years.
to have falling wages.
But you must accept that Brexit has at least put a lot of companies' decisions on hold, and they say so maybe there'll be a spurt later on when they know how it's working out. But at the moment, they're saying we better wait and see.
Right? A year ago, when I was on this programme, I thought the economy would do well over the last year. It has done. I then called it a Nike swoosh. I said that we might have an impact on uncertainty. The trouble is, for any economy, British included, the outlook depends on the interaction between the fundamentals, policy and confidence. Of those, the one that's most difficult to predict is confidence. If the leaders start to talk us into an unnecessary downturn, then even those people and those companies with the ability to spend will not spend.
But
what I'm saying is that one needs to have more balance in the debate. And Brexit does have challenges, but it has great opportunities.
If we have an unplanned Brexit and a weakening economy, that's the worst of all worlds, Gerard. That is terrifying for most people involved, both in the public and the private sector.
The debate remains unresolved. Thank you both very much indeed.